Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be analyzing the company Celanese, and this was actually brought up by Juan Andres Vargas Rodriguez, where he pretty much just said, bro, can you do a video about Celanese, the ticker symbol CE. So guys, let's actually take a look at this company based on their fundamentals and see if at the current share price we would like to buy it. Now this company guys makes polymers, which is actually a really cool kind of company and kind of industry that I personally like the best, on top of just like the whole semiconductor stuff as well. So I'm really hoping that this company is actually able to back up what they do with their fundamentals. So with that said, let's get started with this analysis. We're going to start off with a dividend, guys. This company does pay out a dividend of 2.89%, 68 cents per share, which ends up being $2.72 in annual payout. A payout ratio of 50,000. I am not going to pay attention to this. We have seen this before when it comes to seeking alpha. For some reason, they messed this up. I don't know why, but essentially, guys, is very much incorrect. 5-year growth rate of 10.65, which is actually fairly good, and 12 consecutive years of this dividend being paid out, which is also fairly good. Ex-dividend day passed as of July 22nd. Payout date was August 8th, and they pay their dividends quarterly. Looking now into the calculator, we got the ticker symbol for CE, market cap of $10.5 billion, PE of 5.41, which means that the current share price of $96.90, this might actually be a very decent price. And in fact guys, we can actually see that they're not at the 52-week low, but they're essentially towards the latter end of this 52-week range. So again, this might actually be a fairly decent price to buy at with that current PE. Now as stated, $2.72 in annual dividends per share. This ends up being almost $300 million being paid out in dividends every single year based off of their shares outstanding, and based off the 5-year average free cash flow after this is subtracted, they are left with $727.42 million. And when it comes to their last year's free cash flow, they're almost left with $1 billion, guys. That's actually very healthy. These payout ratios come out to be 22.84% on the last year's free cash flow and 28.82%. Basically, they can 100% and continue to increase this dividend into the future. Taking a look now at some fundamentals, starting of course with the net income, we got 5 years ago at $843 million to 1 year ago of $1.9 billion, increase of 124%. Now the funny thing here is that guys, 2 years ago it was with COVID, and they actually did fairly good. They actually reached their peak during COVID at almost $2 billion, and 3 years ago they actually went down to $852 million from 4 years ago of $1.2 billion. Now this is a trend that we kind of see around this company, and we'll see it in the next upcoming kinds of fundamentals. But for that reason guys, the fact that they did go down from 4 to 3 years ago, it wasn't COVID related, on top of the fact that they did a massive jump from 3 to 2 years ago, I'm going to give this guys like a 70%. Coming now into the free cash flow, the most important of all the profit metrics, we got 5 years ago guys of $536 million to 1 year ago of $1.3 billion, increase of 141%. Now something interesting when it comes to this guys is that they are increasing on the 5 year. However, you can clearly see that from 4 years ago to 2 years ago, they were actually decreasing. And even though the 2 year ago value is understandable because of again COVID, guys, we do see something here similar to that of the net income, where from 4 years ago to 3 years ago, they did go down by around $200 million or so. Again, please do your own research and figure out why this occurred when it comes to these two metrics so far. But all in all guys, I'm actually going to give this a grade of around like a 60%, mainly because you do see a lot of years now declining, but at the same time we don't really have much of an increase, like an outlier increase overall. So you know what, I'm actually going to take that back, and I'm going to say at around like a 75% or so. Coming into the revenue, we actually see something similar to that of the free cash flow. 5 years ago of $6.14 billion to 1 year ago of $8.5 billion, increase of 39.04%. And again, from 4 to 2 years ago, decreasing. And the surprise one here is that from 4 to 3 years ago, it was decreasing as well. Again, figure out what happened in here guys, but overall it is increasing, and you can see it is not that big of an outlier. So I'm actually going to give it the same as that of the free cash flow, which I gave it of 75%. Looking now at the assets minus the total liabilities. In this case, guys, we want the assets to be higher than the liabilities, obviously, because if the liabilities are higher, then, well, they might actually go under. Now, looking at this graph, guys, this is actually fairly interesting. As of today, there are $5.2 billion in this difference. And you can see they have been positive within the past 5 years. However, once again, you see this outlier year here 3 years ago again, where they came down by around like $1 billion. It was actually less than $1 billion or so from the previous 4 year ago. But ever since then, guys, it has been consistently increasing. Average assets, it's around 10.6 billion. Average liabilities is 6.8 billion. Doing this difference, we get almost $3.9 billion. I'm actually going to give this guy's a grade of essentially like an 85%. This is actually looking really, really good. Now looking at the cash flow minus liabilities. Now cash flow, guys, has a multitude of things that it can be used for, and one of them is to pay down their debts as well as pay out a dividend, which is why you want the cash flow to be really, really consistent. 5 years ago, guys, they were at negative $5.7 billion, and as of 1 year ago, they're at negative $6 billion. Now this is a decrease overall. However, what I normally like to look for here is that are they at least trying to bring this back down to zero? Now, they only had 1 year where this occurred, and this was from 5 years ago to 4 years ago. And beyond that, guys, they have just been getting further and further into the negative. Average cash flow minus the average liabilities, we get negative $5.6 billion. I'm going to give this guy like a 40%, mainly because they don't really have that much of a history of bringing this back down to zero, only 1 year, so I'm going to go with a 40%. Looking at the shares outstanding, the most underrated of all the metrics, because unfortunately people don't tend to look at these. However, I look at these, and this essentially tells us whether or not the company is diluting you as the investor. Guys, you want a company to be buying back shares, especially when the share price is really, really cheap, like this one seems to be, with a 52-week low, or at least close to a 52-week low. 5 years ago of 135.8 million shares to today of 108.3 million shares. That is a decrease of 20.25%. However, on the previous year to the current year, just looking at 1 year ago to today, they did increase it, guys, by around like 300,000 shares. So that's actually fairly interesting. Only an increase of 0.28% though. That's not really much of an issue for me. So overall, guys, I'm actually going to give this almost a perfect score. I'm going to give this like a 95% because every single year they have been decreasing this fairly consistently, and only this year is when they barely just increased it by a little bit. So not worried at all. And now when it comes to the cash and equivalents, they currently hold $783 million with an average of $622 million. Looking at the weighted grade, guys, we get a 70% for the net income, 75% for the free cash flow, 75% for the revenue, 85% for the assets minus liabilities, 40% cash flow minus liabilities, and a shares outstanding of 95%, with an overall grade, guys, of 75%. This actually doesn't look too shabby. Now, with this current drop and near 52-week lows, do we buy it at this point? Let's find out. So, guys, we are here at the discounted free cash flow. Let's make 3 assumptions, low, median, high, using, of course, 3 factors: revenue growth, projected share buyback, and the required rate of return, which I like to keep flat at 10%. So for the revenue growth, guys, looking at the growth tab on Seeking Alpha, we can see that the growth forward is 18.33 and the year over year has been 36.68. I'm not gonna go with these guys. I'm gonna go fairly lower, because I think that we're going into harder times now and companies in general are going to suffer overall. So for that reason, let's give the low assumption of a revenue growth of like 5%. For the median, let's go up to 7%, and for the high one, let's go up to 9%. Now for the projected share buyback, they have been buying back, guys, at around 20%. A little bit of issuing shares from last year to today, but it's not too much. Now, they won't be doing 20% probably in the near future, but I think that they'll continue to buy back shares, seeing that the share price is fairly cheap even still. So with that said, guys, I'm going to say for the low assumption of around like 6%. For the median assumption, let's go up to 7%, and for the highest assumption, let's go up to 8%. Now, with all of that said, guys, we get target share prices for this company of $281.79 for the low one, $304.89 for the median, and $329.56 for the high one. Now, adjusting for debt, this comes down, as you could see, because they actually have more debt than they do cash. This comes down to $257.05, $279.90, and $304.31. Adding margin of safety, 5, 10, and 15%. This puts me between the ranges of $218.50 to $244 for the low assumption, $238 to $266 for the median, and $258.66 to $289.09. Guys, the current share price is $96.90. Now, some of you guys are saying these numbers are way over the top. You're telling me that this should be worth this much, yet the share price is $96.90, and they have never reached to the $200 mark. The highest that they ever got to was $176. Well, understand how this kind of free cash flow works, guys. The fact of the matter is that they do have increasing revenue, and on top of that, guys, they are buying back shares. So if in the future they continue to grow this revenue at this amount of rate of 5, 7, or 9%, and they continue to buy back shares, this means that because there's less shares out there in the market, the value of the shares that are out there, that are outstanding, that are left, should be valued a lot more. Does that mean that that will happen? No, but I'm saying this is the intrinsic value of the company. Essentially, the company should be worth at around this point. And again, guys, the PE is 5.41. So again, take these numbers as you will. Obviously, they're based off of my assumptions. Every investment is the present value of all future cash flow, as well as this is not financial advice, guys. If you don't believe these numbers, then please have this calculator, change them for yourselves. For example, let's say that you think that they'll do -5% in revenue and that they'll do -6% in share buyback, meaning they'll issue shares. Well, guys, now these numbers change drastically, as you can clearly see. 174 now, target share price, not adjusting for debt, and with a 15% margin of safety, $129. If that seems more reasonable to you, then please change these numbers to whatever you wish. This is why I have this calculator, guys. It's available for free, as well as my book value calculator, my re-evaluation calculator, and a dividend tracking sheet for companies like these that also pay out a dividend. We'll go into that a little bit further in just one second. All I'm asking for in return, guys, for free stuff, free content, is just help me grow my channel. Like, subscribe, comment. It really does help. Guys, I also put out a poll on my community post asking if you guys would like to see a live stream on the 13th when CPI comes out. I'll probably do it at around 7 p.m. Eastern. So if you guys want to see a live stream of just me going over the CPI, I can also take on some stock recommendations, like analysis and that kind of stuff. I could also do that too. But again, please go to my community post. It should be the second poll I put out. So yeah, if you guys are interested in that, make sure you go vote. But again, all I'm asking for in return, guys, is just help me grow my channel. Like, subscribe, comment. It really does help here with the algorithm on YouTube. Thank you so much for everybody who have subscribed so far. I'm indebted to pretty much all of you, because honestly, I could have not gone this far without just all of you mad lads and mad ladies just completely going ham and just putting me over the top. So thank you all so much. I really do appreciate it. And I'm really eager to make these kinds of videos and provide you guys with more content. Now let's actually take a look at this dividend, because $2.72 is actually not too shabby. If you were to put in $5,725, this would get you 59.08 shares. And remember, the calculator is telling me that this is a pretty decent price to buy it at. Guys, this would net you an annual dividends of $160.71, quarterly of $40.18, and a monthly of $13.39. Not too shabby. I personally would like it if this was over 200, but then again, this is one of those cases that you might be willing to buy it, not just for its dividend, but also for the share appreciation. All in all, guys, CE, not a bad looking company, honestly. I like the fact that they do polymers. I really am a fan of that kind of industry. And their fundamentals aren't too shabby either. As again, I just showed you guys my weighted grade. They gave it 75%. It is fairly decent. Obviously, they need to fix some stuff, but aside from that, it is not too shabby. Thank you so much for the recommendation, Juan. And yeah, this is actually a very good looking company. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites, a link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.